All right, buckle up. Welcome to the deep dive. We are plunging headfirst today into some pretty significant economic news. News that didn't just make waves, it pretty much dropped a bomb on market expectations.
Yeah, it really did. And as we'll see, it immediately sparked quite a bit of political reaction, too.
Absolutely. So this is our deep dive into a recent report on the U.S. labor market. It might seem like just one piece of data, but believe me, it carries some incredibly significant implications. And we're going to unpack those based only on our source material today.
That's right. We've got an article here that detailed this key employment data point, the ADP report, and crucially, the reactions that followed, both in the markets and, as you said, politically.
So our mission today, for you listening, is to really slice through this report. We want to extract the most critical nuggets of knowledge, lay them out clearly so you can understand exactly what the numbers revealed.
And why they were so surprising, why the market reacted the way it did, and, what the fallout has been, particularly when we think about central bank policy, the Fed, and that political commentary we mentioned.
Exactly. And just to be super clear, everything we discussed today comes strictly and only from the details presented in this specific source material we're working from.
Consider it your shortcut to being genuinely well-informed on this specific, quite pivotal moment in the recent economic news cycle, because it really did stir the pot.
It certainly did. The report, as our source highlights, contained some figures that were just way off what analysts were predicting. And that surprise, as the source points out, led to some instant and very, very public reactions.
Yes, notably from a very prominent political figure mentioned specifically in the article. We'll definitely get into that whole political dimension.
Oh, absolutely. But first things first, let's get to the core data itself. Let's unpack this. The heart of this report, the thing that caused all the fuss, was the May ADP employment figure.
Correct. And for those who might not follow this super closely, the ADP report is the private sector payroll report. It often comes out a couple of days before the official government employment numbers, the NFP, so people look at it as, maybe a precursor, an indicator.
Right, the sort of early signal.
Exactly. And the headline finding from this May ADP data, as our source material reports it, was, well, genuinely surprising. The article states it very clearly. The U.S. May small non-farm ADP employment data fell to a nearly two-year low point. That phrase itself, nearly two-year low point, is significant.
And the source even uses a specific Chinese phrase, "baling," doesn't it? What does that capture?
It does. 80 really captures that sense of a big surprise, a major upset, something totally unexpected, like a dark horse winning a race. It means it massively missed expectations. It wasn't just a little bit off, it was a shock.
A T, indeed. And the reason it was such a shock, such an upset, becomes crystal clear when you look at the actual numbers presented in the source. According to the data detailed right there, the increase in May ADP employment was just 37,000 people.
Yes, that figure, 37,000. Let that sink in for a moment. Just 37,000 jobs added in the private sector during the entire month of May, according to this ADP report. That number alone is what immediately grabbed everyone's attention.
37,000, okay. And its significance isn't just the number itself, low as it is, but how it stacks up against what the market was braced for, right?
Precisely. The source article draws a really stark contrast here. It explicitly states that the market expectation, the consensus forecast among analysts, was for an increase of 110,000 people.
Hold on, let me get this straight. The actual reported number was 37,000. The expectation was 110,000.
That's correct. 37K versus an expected 110K.
So the reported gain was, wow, less than 35% of what was expected, less than a third. We're talking about a miss of 73,000 jobs compared to the consensus forecast cited right there in the source.
73,000 jobs below expectations in a single report.
What is that magnitude of a gap? I mean, over 70,000 jobs below what analysts predicted. What does that tell us about where the market thought the labor market was heading versus where this specific data point says it actually went in May?
Well, it strongly implies a significant misjudgment by the market, or at least by the consensus forecast, about the underlying pace of private sector hiring. It suggests that whatever models or other data points analysts were looking at led them to believe hiring was proceeding at a reasonably moderate pace.
They were expecting something like 110,000, which isn't gangbusters, but it's steady growth.
Exactly. Steady, moderate expansion. So when a major report like ADP comes in at less than 35% of that expected figure, it signals that the reality, at least as measured by this specific data set for May, is dramatically weaker than was generally believed just moments before the release.
It must force a pretty rapid rethink then.
Oh, absolutely. A rapid and probably uncomfortable reassessment of labor market health, of its momentum, right across the board. You can't just ignore a miss of that size. It makes you question the assumptions you were working with.
And it wasn't just that it missed the forecast for May. The source also points out it was a sharp slowdown from the previous month, April.
Yes, that's another key piece of context provided. The report compares the May figure of 37,000 directly to April's revised number, and it states that April's increase was revised to 62,000 jobs.
Okay, so April saw 62,000 jobs added, according to the revised figure in the source. And then May comes in at just 37,000.
That's right, from 62,000 down to 37,000 in just 1 month. The pace of hiring reported by ADP, therefore, more than halved month over month. That's a very, very rapid loss of momentum.
It really is. It suggests that whatever slowdown might have been underway, it appears to have accelerated quite sharply in May, at least according to this ADP data.
Precisely. It paints a picture of weakening momentum gathering speed during that specific month.
And let's go back to that headline description. The source used nearly two-year low point. That's a strong statement. Does the source give us the specific time frame that defines nearly 2 years?
It does, and this is important for grounding that claim. The report explicitly states that this 37,000 figure for May 2025 is the smallest increase recorded by the ADP report since March 2023.
March 2023. Okay, so why is using March 2023 as the reference point significant here?
Because it provides the specific context for nearly 2 years. March 2023 is what, about 26 months prior to May 2025. So it positions this May reading as the weakest private sector hiring signal from this particular source, ADP, in well over 2 years.
Right. It's not just a random low number. It's the lowest in quite a specific and extended period.
Exactly. It underscores just how unusual and weak this report was felt to be, placing it in the historical context provided by the article. It's not just a miss against expectations. It's potentially signaling a return to a hiring pace not seen since a very different point in the economic cycle back in early 2023.
Okay, so let's recap the core surprise here, based purely on the source. The number itself, 37,000, astonishingly low. It represents a massive shortfall against the market expectation of 110,000. It shows a sharp deceleration from the prior month's 62,000, and it's the weakest print from this source in nearly 2 years, going back to March 2023. That's the bombshell.
That is the foundational surprise, yes. The
Yeah.
three moment.
So what happened immediately in the markets the second this data hit the news wires? The source details some very specific reactions.
The market reaction, as described in the source, was pretty much immediate and frankly textbook for this kind of unexpectedly weak economic data. Data that suggests, a potential shift in the outlook for economic growth and, crucially, for interest rate.
Okay, what specifically did the source mention?
First, it notes that the U.S. dollar index saw a short-term fall. The source uses the term dia, meaning it dipped quickly right after the data release. It even provides the specific reading at that moment, 99.019.
The U.S. dollar index that tracks the dollar's value against a basket of other major currencies like the euro, yen, etc. Why does weaker U.S. employment data typically cause the dollar to fall? What's the logic there, based on general principles relevant to the source's report?
Well, weaker economic data, like a significant slowdown in hiring reported here, is often interpreted by markets as a signal that the U.S. economy is losing steam, maybe faster than previously thought. This, in turn, can increase the likelihood that the central bank, the Federal Reserve, might need to cut interest rates sooner or perhaps more aggressively in the future to try and stimulate activity.
Okay, so weak data potentially means lower interest rates down the line.
Right. And lower interest rates generally make a country's assets, like U.S. government bonds, less attractive to foreign investors because the yield, the return they can earn, is lower compared to elsewhere. So if there's reduced demand for dollar-denominated assets, that can link to decreased demand for the U.S. dollar itself, causing its value to fall relative to other currencies.
Ah, okay. So the dollar index dipping to 99.019, as the source reported, is consistent with the market immediately thinking, this weak data makes Fed rate cuts more likely sooner, making the dollar less attractive.
Exactly. That's the standard interpretation reflected in the market move described.
And it wasn't just the currency market reacting. The source also highlights a significant move in a really important market, the U.S. government bond market.
Yes, absolutely. The report states that the yield on the benchmark U.S. 10-year Treasury note experienced a sharp drop. The source uses the term dafu teşekkül, which literally translates to a big dive or plunge. It signifies a very rapid and significant fall in yields.
The 10-year Treasury yield. Why is that particular yield so sensitive to this kind of news?
Bond yields, especially on longer-term bonds like the 10-year Treasury, are highly sensitive to expectations about future interest rates set by the Fed and also to prospects for overall economic growth and inflation. When data like this ADP report comes out suggesting the economy is slowing down significantly and the Fed might cut rates, investors tend to rush to buy bonds.
Why buy bonds in that scenario?
Because if you think interest rates are going down, you want to lock in the current higher yields before they fall. This increased demand drives up bond prices. And because bond prices and yields move inversely, like a seesaw, higher prices mean lower yields.
Got it. So the sharp drop or plunge in the 10-year yield reported by the source signals that bond market participants very quickly adjusted their expectations. They saw the weak ADP number and thought, okay, lower growth, likely earlier Fed cuts, and piled into bonds, pushing yields down hard.
That's precisely the dynamic the source is describing, a rapid repricing of interest rate expectations in the bond market.
And then there's gold. The source reports that XAUUSD, which is the symbol for gold priced in US dollars, saw a pull-up, a rise. The term used is Lawsham. And it notes the specific price figure at that moment, $369.53 US dollars per ounce. Gold often moves differently. What explains its rise here based on the signals in the source?
Gold's reaction fits into this picture as well. Gold is often viewed traditionally as a safe haven asset. When economic uncertainty increases, as it certainly did with the surprise data, or when other financial assets like stocks or bonds become less attractive due to falling yields or currency values, investors sometimes seek refuge in gold.
So it's a flight to safety thing?
Partly, yes. But there are other factors, too. Gold doesn't pay any interest or dividends, so its relative attractiveness actually increases when the yield available on interest-bearing assets, like those treasury bonds whose yield just plunged, falls. The opportunity cost of holding gold goes down.
Makes sense. If bonds aren't paying much, maybe gold looks better by comparison.
Exactly. Plus, a weaker U.S. dollar, which we just discussed happened, also tends to support gold prices. Since gold is priced globally in U.S. dollars, a fall in the dollar makes gold cheaper for buyers using other currencies, potentially boosting demand.
Okay, so the source is painting a picture where the weak ADP data triggered a rise in gold because of maybe increased uncertainty, falling bond yields making gold relatively more attractive, and a weaker dollar making it cheaper for some buyers, all working together.
Yes, the combination of those factors, rising economic uncertainty stemming from the surprising data, falling bond yields, and a weaker dollar, all reported in the source as immediate reactions to the ADP release, aligns perfectly with the observed rise in gold prices to that $369.53 level mentioned. It reflects the market pricing in a more risk-off sentiment and adjusting to the prospect of lower future interest rates.
So the headline number was an undeniable shock, a K. And these immediate market reactions detailed in the source, dollar down, bond yields plunging, gold up, they really confirmed just how jarring that surprise was to the financial world. It wasn't a minor miss, it moved markets instantly.
Absolutely. The reactions validate the significance of the data miss.
But the source doesn't just leave us with the top line number and the market moves. It provides something crucial for deeper understanding, a sectoral breakdown. Where did these few jobs actually get added or lost?
And that breakdown, provided right there in the article, is essential. Looking beyond that single headline figure of 37,000 gives us a much richer, more nuanced picture of where this slowdown actually occurred according to the ADP data.
Why is that so important?
Because it tells us which specific parts of the economy were driving this overall weakness. Was it widespread or concentrated? Were there any areas still showing strength even amidst the gloom? The sectoral details help us diagnose the nature of the slowdown reported.
Okay, let's dig into that. The source breaks it down into goods production and services. Let's start with goods production. What did the report say about job changes there in May?
The source states that the goods production sector as a whole registered a net loss of 2,000 jobs during the month of May.
A net loss of 2,000. So right away, that tells us this part of the economy, the part that makes physical things, was actually contracting slightly in terms of jobs, pulling the overall number down, according to the ADP report.
Correct. It was a drag on the total employment figure. But the article then helpfully gives us the components within goods production that led to this net loss. It's not a uniform picture inside the sector.
Right, and that's where the real insight often lies, isn't it? In those underlying components. What did the source list?
Precisely. The report lists specific subsectors within goods production. It says natural resources and mining saw a loss of 5,000 jobs in May. That's things like oil drilling, coal mining, etc.
Okay, 5,000 jobs lost there. What else?
Manufacturing also experienced a decrease, shedding 3,000 jobs in the month, according to the source. So factories, production lines, also seeing job losses.
Right, so adding those up, a loss of 5,000 in natural resources and mining, plus a loss of 3,000 in manufacturing. That's a combined loss of 8,000 jobs from just those two areas within the goods sector, based on the source's numbers.
That's exactly right. 8,000 jobs gone from those two specific components. However, the source then immediately notes a contrasting trend within the same goods production sector. It says the construction sector actually went against this grain, adding 6,000 jobs in May.
Ah, interesting. So while mining and manufacturing were shedding workers, the construction industry was still hiring, adding 6,000 people.
Yes, building houses, infrastructure projects, that sort of thing. According to this report, that sector was still expanding its workforce.
So that gain in construction, the 6,000 jobs added as reported, must have helped cushion the blow from the losses elsewhere in the goods sector.
Exactly. The article points this out. That 6,000 job gain in construction effectively offset a significant portion of the combined 8,000 loss from natural resources mining and manufacturing. Let's do the math based on the source. You have plus 6,000 from construction, Nenesi 5,000 from natural resources mining, and Nanica 3,000 from manufacturing. If you sum those up, 6,000, 5,000, 3,000 equals net is at 2,000.
Which is the net loss of 2,000 jobs for the entire goods production sector that the source reported initially.
Precisely. So spending time on this breakdown, as the source allows us to, reveals that the weakness reported in goods production wasn't monolithic. There were divergent trends. Construction was a relative bright spot, still growing, but the declines in mining and especially manufacturing were substantial enough to pull the whole sector into negative territory for the month, according to this data.
That granular detail really paints a much clearer picture than just saying goods production lost 2,000 jobs. It shows specific pockets of weakness and relative strength.
It highlights divergent trends even within broad categories of the economy, based purely on the data presented in the source.
Okay, so goods production overall was a slight drag, pulled down by mining and manufacturing, despite construction strength. Now, what about the much larger services sector? The source describes it in a kind of mixed way, saying it showed some strong signs, but also overall pressured the total employment number. That sounds like an even more complex picture brewing there.
It is, according to the source's description and the underlying numbers it provides. The services sector is huge, encompassing everything from restaurants and retail to finance, healthcare, tech, and transportation, so you'd expect more variation.
So where were these strong signs the source mentions? Which service industries were still hiring well in May?
The report breaks this down into several key service subsectors, showing where gains were still robust and, crucially, where the losses occurred that put pressure on the total. On the positive side, the source highlights leisure and hospitality as a real standout. It reportedly added a very strong 38,000 jobs in May.
38,000. In leisure and hospitality alone.
That's the number reported in the source, yes. Restaurants, hotels, entertainment, travel-related services. That sector is specifically mentioned as one of the areas showing some strong signs.
Wait a minute, let me just compare that. Leisure and hospitality added 38,000 jobs, according to the source. The total ADP number reported for the entire private sector economy was only 37,000.
That is a truly striking detail when you put them side by side like that, isn't it? Both numbers drawn directly from the source report.
It really is. What does that specific comparison tell us about the nature of the hiring that did happen in May, according to this ADP report?
It highlights something quite extraordinary. According to the specific ADP data, almost all of the net private sector job growth recorded in May came from just one single industry, leisure and hospitality. It suggests that demand for workers in those consumer-facing service areas remained relatively strong or resilient, acting as basically the primary engine, maybe the only engine, of reported net job creation for the month, even as hiring stalled or actually reversed in many other parts of the economy detailed in the source.
Wow. Were there any other service sectors showing strength?
Yes, the report also notes financial activities as another area showing some strong signs. That sector reportedly added 20,000 jobs in May. things like banking, insurance, real estate.
Okay, so 38,000 from leisure hospitality and 20,000 from financial activities. Adding those together, those two sectors alone contributed a reported 58,000 jobs in May.
Correct. A combined 58,000 jobs from just those two areas highlighted as strong in the source.
But if those two added 58,000 and the total was only 37,000, that means other service sectors must have lost a lot of jobs to pull the total down so much. The source mentioned sectors that constituted pressure on the total number. Where were those losses concentrated within services?
Exactly. The gains in those two areas were clearly offset significantly elsewhere. The report details several important service subsectors that saw job declines in May. Professional and business services reportedly decreased by 17,000 jobs.
Professional and business services, that's things like consulting, accounting, legal, tech services, right? Often higher paying white-collar jobs.
Generally, yes. That category saw a loss of 17,000 according to the source. Education and health services also saw a notable drop, decreasing by 13,000 jobs reported for May.
Education and health, another very large sector. Losing 13,000 jobs there is significant too.
It is. And finally, the source mentions trade, transportation, and utilities decreased by 4,000 jobs in May. This includes retail trade, wholesale trade, warehousing, trucking, utilities, etc.
Okay, let's add up those losses reported within the services sector. 17,000 from professional and business services, plus 13,000 from education and health services, plus 4,000 from trade, transportation, and utilities. Carry the one. That's a combined loss of 34,000 jobs across just those three specific service subsectors, according to the source's numbers.
Precisely. 34,000 jobs lost in those areas. And this is why the source characterizes the services sector overall as being under pressure, despite the strong gains reported elsewhere, like in leisure, hospitality, and finance.
Right, explains the mixed description. Let's see. The source reported gains of 58,000 from leisure, hospitality, and finance, and it reported losses of 34,000 from professive business, ed health, and trade transport utilities. So the net job change in the entire services sector, based on these numbers provided in the report, would be 58,000 minus 34,000, which equals 24,000 jobs.
A net gain of 24,000 for the services sector overall, based on those reported components.
Okay, that makes sense now. So the services sector did contribute net positive jobs, 24,000 according to these numbers. But that contribution was significantly weaker than the strong gains in leisure, hospitality, and finance would suggest, because of those substantial losses reported in white-collar services, education, health, and the trade transport areas.
Exactly. The losses really dragged down the overall service sector performance.
And if we combine the net gain from services, plus 24,000 based on these components, with the net loss from goods production, negative 2,000, that gets us to plus 22,000. The headline number was 37,000. So there must have been other smaller sectors, maybe information or other services not explicitly broken out here, that contributed the remaining 15,000 net jobs.
That seems mathematically correct based on the major components the source did break out for us. But the key point from the source's narrative is that those specific losses in perfect business, ed health, and trade transport utilities constituted pressure on the total number, and that's absolutely borne out by the figures it provides.
Yeah, it really shows the slowdown reported by ADP wasn't uniform at all. It seems it was quite acute in certain, perhaps more interest rate sensitive or cyclically sensitive service areas, even while consumer-facing services like restaurants and hotels and finance held up much better, according to this specific data set.
That unevenness, that divergence within sectors, is a crucial takeaway from the detailed breakdown presented in the source. It paints a much more complex picture of a labor market where weakness is definitely appearing according to ADP, but it's hitting certain industries much, much harder than others right now.
Okay, so we've got the surprisingly weak headline hiring number, the market reaction, and now a much clearer picture of where those gains and losses came from by sector, thanks to the source's details. The report also gives us some information on wage growth, which seems to add yet another layer of complexity to this picture of a potentially cooling labor market.
It really does, because even if the quantity of jobs being added is slowing dramatically, as the 37K number suggests, the price of labor wages can tell us something different, perhaps about remaining tightness or the bargaining power workers still hold, or the cost pressures employers still face.
So what did the source report on wages?
It provides two specific annual wage growth figures from the ADP report. First, for workers who stayed in their jobs over the past year, people who didn't switch employers, the annual wage growth was reported at 4.5%.
4.5% increase year over year for job stayers. That sounds pretty solid, actually.
It's generally considered a healthy pace of wage growth, yes. Now, how does that compare to the rate reported for those who did change jobs during the year?
What did the source say about the job changers?
For workers who changed jobs, the annual wage growth was significantly higher. The source reports it came in at 7%.
Wow, 7% for changing jobs versus 4.5% for staying put. That's a pretty big difference, a 2.5 percentage point premium for switching jobs, according to these figures.
It is a substantial gap, yes. The report explicitly contrasts the 7% for job changers with the 4.5% for job stayers.
Now, even in an environment where the overall hiring number, 37K, is reported as dramatically slowing, what does that specific difference, that large premium for switching jobs reported by the source, imply about the market dynamics, especially for employers who are still trying to fill positions?
It strongly suggests that even with far fewer jobs being created overall, according to this ADP report, the market for new hires, particularly for workers who have skills or experience that are currently in demand, might still be quite competitive. Employers trying to attract talent from other companies apparently still need to offer a substantial pay increase, that 7% premium, to entice people to move.
So it's like the overall pool of jobs isn't growing much, but the competition for specific workers within that pool might still be fierce.
That's one way to interpret the dynamic suggested by these two wage figures presented in the source. It points to a continued competitive element, perhaps in certain segments or for certain roles within the labor market, persisting despite the broader slowdown in hiring volume. Workers who are willing and able to switch jobs are still, according to this data, commanding notably higher pay increases than those who choose to remain with their current employer.
And the source adds a really crucial observation about these wage figures, the 4.5% and 7%. That seems maybe slightly counterintuitive given that shockingly weak 37K hiring number.
Yes, this is a key nuance highlighted in the article. It emphasizes that both of these wage growth figures were little changed from the previous month, April. They didn't suddenly drop off in May alongside the hiring number.
Okay, so wage growth held steady from April to May, according to the source.
Right. And perhaps even more importantly, the source characterizes this level of wage growth, both the 4.5% for stayers and the 7% for changers, as still being at a strong level.
Strong. That's the word the source uses to describe wage growth, even in the same report that showed hiring hitting a nearly 2-year low.
Yes, strong and little changed. This is a critical point emerging from the report's own data and description. According to the source's interpretation, wage growth remains robust and consistent, even as hiring momentum is weakening, quite dramatically.
That's the apparent tension right there, isn't it? We have hiring falling off a cliff in this report, but wage growth is described as strong and steady. If the demand for new workers is falling so sharply, shouldn't we expect to see wage pressures easing up? How does the source help us understand this?
The source itself doesn't explicitly resolve that tension, but it presents the facts side by side. Hiring slowing dramatically, yet wage growth for both stayers and changers remaining strong and little change. This juxtaposition is important.
So what could explain it based just on what's presented? Could wage growth just be a lagging indicator? Maybe it takes time for hiring slowdowns to translate into lower wage offers.
That's certainly one possibility consistent with economic theory. Wage trends often lag changes in hiring volume. Or another interpretation based on the data presented could be that even if fewer positions are being filled overall, the employers who are still hiring, perhaps those competing for the workers commanding that 7% raise, or maybe companies trying desperately to retain their existing staff, the ones getting 4.5%, still face significant wage cost pressures.
Or maybe the hiring slowdown reported is heavily concentrated in lower wage sectors, while higher wage sectors are holding up better, keeping the average wage growth looking strong.
That's another plausible explanation based on the sectoral unevenness we discussed. The source doesn't explicitly state which of these is correct, but it clearly presents this nuanced picture. Weakening hiring momentum exists simultaneously alongside strong and little changed wage growth, according to its own reported data and description. It highlights that the labor market isn't sending just one simple signal right now.
Okay, so we have these specific data points from the ADP report, the low hiring number, the sectoral details showing unevenness, the surprisingly strong wage figures, and how they compare to expectations and past trends. The source then brings in the perspective of experts to help us interpret this complex picture. It quotes or paraphrases the ADP chief economist herself, Neela Richardson. What's her take on the overall trend as reported?
The source includes Mrs. Richardson's assessment to add expert context. It reports her stating that while the year started strong, hiring momentum is weakening. That specific phrase is weakening, coming directly from the head economist of the organization producing the report, carries significant weight.
It's not just an external analyst saying it. It's ADP's own interpretation of their data.
Exactly. It signifies that ADP views this week May number not just as a one-off blip or a fluke, but as part of a developing broader trend of slowing hiring activity in the private sector.
And does she elaborate on that trend beyond just weakening?
Yes. The report says she also commented that recent data, presumably including this May report, indicates the labor market continues to trend softer. This reinforces the idea. Trending softer suggests a gradual loosening, a move away from the very tight labor market conditions we saw previously, towards a state with less intense hiring and perhaps less pressure. The May number is presented as further evidence confirming this ongoing softer trend, according to the ADP's chief economist, as reported in the source.
Okay, so ADP's own expert sees a clear weakening trend. Now, to provide even more context and maybe more complexity, the article connects this surprising ADP report to other recent labor market data points it discusses. It specifically mentions the official JOLTS report. What's JOLTS again?
JOLTS stands for the Job Openings and Labor Turnover Survey. It's an official government report from the Bureau of Labor Statistics that tracks, crucially, the number of job openings employers have, as well as hires and separations, like quits and layoffs.
Got it. So ADP is about actual hiring in the private sector, while JOLTS gives us a read on employer demand via openings and also turnover. What did the source say about the recent JOLTS report? It mentions it came out on Tuesday. Given the likely timing, that would be Tuesday, June 3rd, right before this ADP report.
That seems correct contextually. And this is where the picture, based purely on the source material we have, gets particularly interesting and frankly a bit contradictory or puzzling when placed next to the ADP bombshell.
How so? What did the April JOLTS report show, according to the source?
The source states that the official JOLTS report covering the month of April actually showed that U.S. employers' job openings unexpectedly increased in April. They rose to 7.4 million.
Wait, unexpectedly increased. Job openings went up in April, just before ADP reported that hiring fell to a nearly two-year low in May. That sounds like two very different signals coming from the labor market back-to-back, according to these reports cited in our source.
It certainly appears that way based on the information presented. The source explicitly highlights this unexpected increase in April job openings. It notes that the 7.4 million figure was higher than the market expectation, which it cites as 7.1 million openings.
So openings beat expectations in April.
Yes. And furthermore, the source points out that the 7.4 million level was the best performance since February, meaning job openings reported in April were higher than they had been in both March and February. So not just an increase, but a rise to a two-month high.
Okay, so how, drawing only from what the source presents us with here, do we even begin to reconcile this apparent contradiction? On one hand, we have the May ADP report screaming, sharp slowdown in hiring, weakening momentum, two-year low. On the other hand, we have the official April JOLTS report just 1 month prior, showing employer demand for workers via job openings unexpectedly increasing to a two-month high. What does this specific contrast presented right here in the source tell us about the challenge of getting a clear, unambiguous read on the labor market right now?
It highlights, very vividly, the difficulty in interpreting the labor market's true direction based on individual data points, or even based on different reports that measure slightly different, though related, things. As you said, ADP tracks payrolls, added, actual hiring activity, mostly in the private sector. JOLTS tracks employer demand, job openings, and turnover, hires, quits, layoffs, across the whole economy.
They're looking at slightly different angles.
They are, and the source simply presents these facts side by side, creating this puzzle. Hiring slowed dramatically in May, according to ADP's measure. But the demand for workers, as measured by job openings, actually increased unexpectedly in April, according to the official JOLTS measure.
So what could that mean? Does it mean employers wanted to hire more in April, hence the high openings, but maybe couldn't find the right workers, and then that difficulty translated into much lower actual hiring in May?
That's one possible interpretation that could reconcile the two data points presented. High openings, low hiring could signal persistent mismatches or shortages.
Or is it possible the slowdown in hiring seen in May's ADP is just a much more recent development? Maybe something changed between April and May that wasn't yet captured in April's JOLTS data showing strong demand.
That's another plausible interpretation. Maybe demand was strong in April, but cooled rapidly in May, leading to the weak ADP number. The source itself doesn't definitively resolve this tension between the two reports it cites. It simply presents it as part of the current complex labor market picture. It tells us that based on these two specific reports, the signals being sent are mixed, maybe even conflicting. Employer demand looked unexpectedly strong as of April, while actual hiring looked surprisingly weak in May.
Okay, so the picture is definitely murky based on those two reports.
Yeah.
The source also provides another metric from that same April JOLTS report, the job openings to unemployed ratio. What did it say about that?
Yes, it notes that this ratio, which compares the number of available job openings to the number of officially unemployed people, fell slightly in April to 1.03 to 1. The source describes this level as almost flat compared to the previous month, March.
1.03 to 1. So for every 100 officially unemployed people in April, there were 103 job openings available. What does that specific ratio and the fact it was almost flat indicate about labor market tightness based on how this metric is typically interpreted?
This ratio is often used as a key barometer of how much slack or tightness exists in the labor market. A ratio significantly above 1, like we saw maybe a year or two ago when it was closer to 2 to 1, suggests a very tight market, far more jobs available than people looking for work, giving workers lots of bargaining power and making it hard for employers to fill positions.
And a ratio below 1 would mean more unemployed people than jobs, suggesting slack.
Correct. A ratio close to 1, like this 1.03 reported for April, suggests a market that's much more balanced. It indicates there were still slightly more job openings than unemployed individuals, so maybe leaning just a tiny bit towards tightness, but the edge is minimal. And the fact that the source says it was almost flat compared to March suggests that this state of near balance wasn't changing much, at least between March and April, according to this specific measure.
So even the ratio is sending a kind of lukewarm signal. Not super tight, not super slack, just sort of balanced and stable as of April.
That seems to be the implication of the 1.03 figure and the almost flat description provided in the source for that JOLT test ratio in April. It adds another layer to the complexity openings, surprisingly up, but the ratio barely moving and staying near balance.
Okay, so let's pull these threads together. We have the surprisingly weak May ADP hiring number, 37K. We had the contradictory official April JOLT test data showing increased job openings, 7.4 meters. We had the JOLT test ratio from April suggesting a near balanced market, 1.03.1. That's not changing much. And we have the ADP chief economist confirming weakening momentum. This all naturally leads us to look ahead, as the source does, to the next big labor market report. The official May non-farm payrolls NFP data, which the source mentions is scheduled for release this Friday. Contextually, that would be Friday, June 7th.
Yes, the NFP report is often considered the most comprehensive and widely watched measure of U.S. employment. It covers total non-farm employment, including government jobs, unlike ADP, which is private sector only, the official unemployment rate, and average hourly earnings. So after this confusing ADP report, all eyes will be on the NFP for confirmation or contradiction.
And the source sets the stage for that crucial upcoming report by telling us what the market expectations were for the May NFP, presumably before this ADP shock.
It does. It states that the consensus expectation among economists for official NFP growth in May is an increase of 125,000 people.
125,000. Okay, that's quite a bit higher than the 37,000 reported by ADP, but maybe still represents a slowdown from previous months. What about the unemployment rate expectation?
The source gives the expectation for the official unemployment rate as well. It's expected to be stable at 4.2%.
Okay, so the market was looking for a 125K job gain and a steady 4.2% unemployment rate in the official May report. Now, crucially, how does the source say that unexpectedly weak May ADP report we've spent so much time on might influence those expectations for the official NFP number coming on Friday?
The source specifically notes this connection. It states that based on this weak ADP report, there's now an indication that the official NFP growth might slow. The source uses the phrase "sung singsu wo yu sung fenggue," meaning growth rate might slow down somewhat.
So the ADP shock is making analysts think the official number might come in weaker than that 125K forecast.
That's the suggestion presented in the source. The sharp slowdown reported by ADP and private payrolls is leading analysts to consider, or perhaps revise downwards, their expectations for the broader government measure of total non-farm employment. It implies the risk is now tilted towards the NFP, potentially missing that 125K forecast and showing a softer gain in May, though 125K is still, obviously, much higher than the 37K seen in the ADP report itself. The ADP report has injected significant uncertainty into the NFP outlook.
This whole complex picture, the mixed data points, the contradictory signals, the uncertain outlook for the next big report seems to be really well encapsulated by the perspective of another economist cited in the source.
Yes, the article includes the view from Alison Trivastava, who is identified as an economist at Indeed, the job search company. Her perspective adds another dimension to understanding the current state described.
And she uses a very striking phrase, according to the source, to describe the labor market.
She does. She is quoted or paraphrased as describing the labor market as remaining in a painful stalemate. The source uses the Chinese hao as "anenchen dezhangju," which conveys a sense of being stuck in a deadlock that is causing distress or pain.
Painful stalemate.
Mm.
That phrase itself, as reported in the source, is quite evocative. What exactly constitutes this stalemate, according to her view as presented in the article? What are the components of this deadlock?
The source says she attributes this painful stalemate to two specific coexisting factors: limited hiring and low resignation rates.
Limited hiring and low resignation rates. Let's unpack that combination based purely on what the source presents about her view. What does that imply for the average worker or for the overall dynamism of the job market?
Well, limited hiring clearly means there aren't many new job opportunities being created, consistent with the weak ADP number we saw. Low resignation rates, sometimes called the quit rate, means people aren't voluntarily leaving their current jobs very frequently.
So people aren't moving around much.
Exactly. And when you put those two together, as this economist does, according to the source, it suggests a situation where finding a new job is difficult because employers simply aren't adding many positions. And perhaps because finding a new job is difficult, workers are choosing to stay put in their current roles, even if they aren't entirely satisfied or see better opportunities elsewhere, because the alternative, facing a tough job search or potential unemployment, seems too risky.
So it creates this kind of stuck, stagnant situation. Difficult to get hired, and maybe therefore reluctant to quit. That sounds like a stalemate and potentially painful for people wanting career progression or better pay.
That seems to be the implication of her painful stalemate diagnosis. Rooted in those two specific conditions of limited hiring and low resignation rates, as reported in the source, it points to a lack of churn and dynamism in the market.
And she doesn't just diagnose the problem, she issues a warning about this situation, also quoted or paraphrased in the source material.
She does. It's quite a stark warning presented in the article. The source reports her saying that the market cannot maintain a stable cooling forever, or it will turn thoroughly cold. The source uses the phrase "si bien lang" for turn thoroughly cold.
Cannot maintain a stable cooling forever, or it will turn thoroughly cold. What's the implication of that specific warning, as presented?
It implies that the current state, which she calls a painful stalemate, and which others might describe as a period of stable cooling, meaning the market is slowing down gradually without collapsing entirely, is inherently unstable or precarious. It can't last indefinitely, in her view.
It's not a sustainable equilibrium.
Apparently not, according to her reported warning. If this condition of limited hiring and low quits persists without improvement, the risk she highlights is that the slowdown could suddenly accelerate and deepen significantly. The phrase "turn thoroughly cold," as reported, suggests a scenario far worse than just a continued gentle slowdown. It evokes imagery of a market potentially freezing up, maybe widespread job losses, a halt to hiring altogether, or a much more severe economic downturn impacting labor conditions broadly.
So her warning, as presented in the source, highlights the fragile nature of the current situation. It's not just slow, it's potentially dangerously close to something much worse if things don't change direction.
That's the essence of the risk she's flagging, according to the source's reporting of her view. The stalemate could break in the wrong direction.
Wow, okay. So we've really delved deep into the data itself, the ADP shocker, the immediate market reaction, the granular sectoral details showing unevenness, the nuances of strong wage growth alongside weak hiring, the complex and contradictory signals from other labor data like JOLTS, and these expert interpretations including warnings about a painful stalemate potentially turning thoroughly cold. This sets the stage perfectly for the next major reaction, the source highlights, which happened almost instantly after this ADP data dropped. Let's pivot now to what happened on the political front, as vividly reported in the source material.
Yes, this is where the narrative takes a sharp turn towards the political arena, and the source emphasizes just how quickly it happened. The article notes, using the word immediately, or its equivalent suiji, multiple times for emphasis, that immediately after the week ADP report was published, Donald Trump immediately targeted Federal Reserve Chairman Jerome Powell.
That speed immediately is really telling, isn't it?
It is. The source's use of that word twice in describing the reaction underscores just how quickly and directly this specific economic data point translated into high-level political commentary and, frankly, pressure. It shows that economic data, especially concerning employment figures, is clearly highly sensitive politically, and this weak ADP report was absolutely no exception. It became political fodder instantly.
And the source doesn't just say Trump reacted. It details exactly what he said in response to this specific ADP report, laying out his criticisms and his demands quite pointedly.
It does, presenting his language and directives very clearly, making sure the reader understands these are his stated views as reported. The source reports that Trump, reacting specifically to these May ADP numbers, referred to Powell using a particular nickname. He called him "Too Late, Mr. Powell."
Too late, Mr. Powell. That specific nickname, as reported by the source, is quite loaded. What does it imply about Trump's view of Powell's actions, particularly regarding interest rates, based on the context provided by the source material here?
Based on the source's reporting of Trump's subsequent demands and its mention of his past criticisms, the nickname "Too Late, Mr." clearly implies a strong accusation from Trump that Chairman Powell has waited far, far too long to begin lowering interest rates. It frames Powell's current policy stance holding rates steady as a significant mistake of timing.
Like he missed the window.
Exactly. It suggests Powell missed the opportune moment to ease monetary policy and is now damagingly behind the curve, letting the economy weaken unnecessarily, at least in Trump's view as presented. The nickname itself encapsulates that specific criticism of Powell's perceived delay in cutting rates.
And following that nickname, Trump issued a very direct demand, according to the source.
Extremely direct and forceful. The source reports Trump stating that Powell must cut interest rates immediately. The source uses the emphatic phrase "irrenuelos," which means cut rates right away or immediately.
Must cut.
Yeah.
Immediately. The language reported there is incredibly strong, isn't it?
It really is. As reported in the source, must is a direct, non-negotiable command, not a suggestion, and immediately demands action without any delay whatsoever. This is presented not as friendly advice or gentle encouragement for the Fed chair, but as an urgent, forceful directive from Trump, explicitly and immediately triggered by the release of this weak ADP employment data.
Did the source mention any other judgments Trump made about Powell in this reaction?
Yes, the source also reports that Trump called Powell disappointing,
Yeah.
using the term "lingeren shuang." This is reported as a clear, concise expression of strong dissatisfaction with Powell's performance and his policy choices, particularly in the context of this weaker economic report.
And Trump also used a specific comparison point, according to the source, to try and bolster his argument that the Fed under Powell is lagging behind.
He did. The source reports him making an international comparison, stating Europe has cut rates 9 times. The source uses the phrase "shu non zhengshele."
Europe has cut rates 9 times. How is that comparison being used by Trump here, according to the source's reporting of his statement? What's the point he's trying to make?
As presented in the source as part of Trump's immediate reaction, this comparison serves to highlight his belief that other major central banks, specifically those in Europe, presumably referring collectively to the ECB or perhaps individual European national banks, have been much more proactive and aggressive in easing monetary policy by lowering interest rates multiple times already.
He's trying to paint the Fed as an outlier.
Exactly. By citing this figure of 9 times, whether factually accurate or not is separate, this is what the source reports him saying, Trump, as reported, is trying to portray the Fed under Powell as exceptionally slow, hesitant, or out of step compared to its global peers. This contrast is used to further justify his emphatic demand for immediate rate cuts from the Fed. Look, Europe is doing it, why aren't you? Seems to be the implied message reported.
Now, this kind of criticism isn't exactly new territory for the relationship between Trump and Powell, is it? Does the source provide any background context on their interactions?
The source does confirm that this latest attack fits into an established pattern. It explicitly states that Trump has frequently initiated attacks and even threats against Powell in the past. The source uses the strong phrase, "Attacks
Attacks and even threats. demanding rate cuts.
Yes, strongly demanding Yoki that the Fed cut rates. And crucially, the source emphasizes that these strong demands from Trump have always been refused by Powell. It uses the phrase "윤zal dao 바와이르주지."
So the source establishes this history. Trump frequently pressures Powell. Powell consistently refuses.
Yes, this historical context, as presented in the source, establishes a long-standing tension between the two figures. It also highlights Powell's consistent public stance on maintaining the Federal Reserve's independence from short-term political pressure, which is considered a cornerstone principle for effective central banking globally. His refusals underscore that principle.
And interestingly, the source specifically mentions a very recent and quite notable meeting that occurred between Trump and Powell just before this whole ADP data drama unfolded.
Yes, that's a significant detail included in the report. It notes that Trump actually met with Powell last week, shortly before this ADP data was released and Trump launched this fresh attack.
And the source highlights why this meeting was particularly significant, right?
It does, by providing specific context. It states this was the first time in the second term, that Trump had met with Powell. And perhaps even more strikingly, it was the first meeting since 2019, the noun lai shu jiumian.
Wow, the first meeting since 2019. That's a long gap, spanning basically the entire Biden administration up to that point.
It is. Spending time on that gap from 2019 until last week really underscores how unusual and potentially significant this recent interaction was. It marked the renewal of direct face-to-face contact between these two powerful figures after a considerable hiatus, occurring, of course, in the context of Trump's ongoing political activities and the broader economic discussions happening.
What did they actually talk about during this meeting last week, according to the description provided in the source material? Did the source give any details?
The report provides a brief summary of the key points exchanged, framing it as a continuation of their existing disagreements. It states that during this meeting, Trump reiterated his long-held position, telling Powell directly that the Fed failing to cut interest rates was a mistake. The source uses the phrase, "외는잔지 시익호."
So Trump used the meeting to again push his view that rates should have been cut already? How did Powell respond, according to the source?
In response to Trump stating the lack of cuts was a mistake, the source says Powell insisted on policy independence. It uses the phrase "zaijianqi zhengxie durixing."
He insisted on policy independence. In the specific context of that meeting with Trump, as reported by the source, what does Powell emphasizing that particular principle signify?
In that direct interaction reported by the source, Powell insisting on policy independence means he was, according to the article's description, directly pushing back against Trump's assertion that the Fed should have already cut rates based on political preference or judgment. It signifies that Powell was likely emphasizing the Federal Reserve's statutory mandate. They make monetary policy decisions based on their analysis of economic data relative to their goals, which are typically stable prices and maximum employment, and crucially that these decisions are and should be free from political influence or directives from the executive branch or Congress.
So it's a defense of the Fed's process and its insulation from politics.
Precisely. By highlighting Powell's insistence on this core principle right after reporting Trump's mistake comment, the source underscores Powell's consistent stance against political pressure. It also lays bare the fundamental conflict in their approaches. Trump demanding specific policy actions based on his judgment, and Powell defending the institution's independent, data-driven process as framed by the source.
Okay, so that's the political pressure cooker that reacted so swiftly and forcefully to the weak ADP data, drawing on this history of tension and disagreement over Fed independence. Now, let's pivot back and look at the Federal Reserve's actual current policy position and what the market expects them to do next, based on the information provided in the source. We need to contrast the political demands with the reality on the ground.
Right. It's crucial to separate the political noise from the Fed's stated actions and the market's interpretation, as reported in the source. The source confirms, factually, that the Federal Reserve has maintained interest rates unchanged since December of the previous year.
So despite all the talk and pressure, rates haven't actually moved for quite some time.
Correct. The source further notes that in their most recent formal decision-making meeting, the May policy meeting, 5yu Dezengshi Wuyishang, which concluded just before the surprising May ADP data was released, the Fed decided once again to keep their benchmark federal funds rate steady. They held it in the existing 4.25%, 4.50% range. 微细塞 4.25%, 4.50% PGN.
Okay, so the official stance as of the May meeting was hold steady at 4.25 to 4.50%. Now, has there been any communication from Fed policymakers since that meeting, but before this ADP report, according to the source, that gives us a sense of their thinking?
Yes, the source mentions that. It notes that recently, Fed policymakers have successively spoken out. The phrase used is "hu kisher fizhes yinlai," which is jilan fushing, suggesting a series of public comments from various Fed officials.
And what was the consistent message they were sending in these recent communications as reported?
The consistent message, according to the source, was them reiterating the need for a cautious attitude. The source uses 重申在制定货币政策时谨慎态度, meaning they are repeatedly emphasizing the need to be careful and prudent when setting monetary policy.
A cautious attitude. In the context of deciding whether or not to cut interest rates, what does that phrase, cautious attitude, as reported here, strongly imply about the Fed's likely approach?
It strongly implies that the Fed is not in any rush to lower interest rates. Caution here suggests they are wary of cutting too soon, perhaps reigniting inflation or reacting prematurely to potentially noisy data. It indicates they're likely waiting for more confirming evidence, particularly more consistent data showing inflation is sustainably moving back down towards their 2% target before they feel comfortable enough to actually start easing policy by cutting rates.
So cautious attitude basically signals patience and data dependence, rather than responding hastily to maybe one weak report or political pressure.
That seems to be the clear implication of the Fed's own messaging as characterized by the source: patience over precipitation.
Okay. So given this stated cautious attitude from the Fed itself and the complex, sometimes contradictory signals we've seen from the recent labor market data reported in the source, the weak ADP hiring versus the stronger April JOLTS openings, etc., what is Wall Street's general assessment of the Fed's current position? How do market analysts see the situation the Fed is in, according to the source?
The source provides insight into this Wall Street perspective. It states that financial market participants generally believe, that the Fed is currently caught in a dilemma. The word used is lingnan jingdi, meaning a predicament or a difficult situation with no easy choices.
A dilemma. That's a strong word.
Yeah.
What specific factor does the source say is creating this difficult dilemma for the Fed, in the view of Wall Street analysts as reported?
The report explicitly links this perceived dilemma for the Fed to the ongoing shadow of a tariff war. The phrase used is meaning under the shadow of a tariff war.
The shadow of a tariff war. How does that create a dilemma for the Fed's monetary policy decisions, according to the way the source presents Wall Street's view?
Well, the implication is that the uncertainty surrounding trade policy, potential new tariffs being imposed, existing tariffs impacting supply chains and costs, retaliatory tariffs from other countries makes the Fed's job significantly harder. Tariff conflicts can simultaneously slow economic growth, which might argue for rate cuts, while also potentially pushing up inflation through higher import prices or disrupted production, which might argue for keeping rates higher or even raising them.
So tariffs can pull the economy and inflation in different directions, making it really hard for the Fed to know which problem to prioritize.
Exactly. It creates this complex, murky environment where it's difficult to predict the net impact of trade actions on the overall economy and on the Fed's dual mandate of price stability and maximum employment. Traditional economic signals might get distorted. This uncertainty and these conflicting pressures are what the source frames as the core of the Fed's dilemma, as perceived by Wall Street, operating under the shadow of a tariff war.
Okay, that makes sense. It's a tough balancing act. Now, given this perceived dilemma, combined with the Fed's own reported cautious attitude and the mixed bag of recent economic data we've discussed, what does the market actually expect the Fed to do regarding the timing of any potential future interest rate cuts? Does the source give us the market's prediction?
Yes. Based on this complex landscape described in the source, the article reports specific market expectations for when or if the Fed might finally make a move to cut rates. First, looking at the very next policy meeting. the June policy meeting.
Yeah.
6. Yudizvengo Wiyushang. The source says the market generally expects the Fed to continue to press on or stay put. The phrase used is su, jisu anbing budong, which literally means continue to hold troops still, essentially do nothing, maintain the status quo.
So hold on. Even after seeing that shockingly weak May ADP number, 37K, that kicked off our whole discussion, the market, as reported here by the source, still expects the Fed to keep rates steady in June. They don't expect this data to force an immediate cut.
That's what the source indicates the prevailing market expectation was, yes. No cut expected at the upcoming June meeting, despite the ADP shock.
Why wouldn't that sharp drop in hiring expectations prompt the market to anticipate an earlier move? What factors, based on what the source tells us, might be counterbalancing that weak ADP signal in the market's mind?
According to the context provided throughout the source material, it's likely a combination of the factors we've already touched upon. First, there's the Fed's own clearly communicated cautious attitude. They've signaled they need more than just one potentially noisy report to change course dramatically. They want sustained evidence.
Right, they don't want to overreact.
Second, there's the uncertainty created by that tariff war shadow. The source mentioned this might make the Fed itself hesitant to act prematurely, preferring to wait and see how those potential impacts unfold. Third, the market is almost certainly waiting for more comprehensive data, most importantly, the official May non-farm payrolls report coming this Friday, as noted multiple times in the source.
They want to see the bigger picture from the NFP.
Exactly. Even a very weak ADP number might not be considered sufficient on its own to force an immediate June cut when the Fed is prioritizing patience. Looking at the totality of the data, which includes potentially conflicting signals like the stronger April JOLTS openings, also mentioned in the source, and facing external uncertainties like trade policy. So the market expectation of no change in June, reported by the source, seems plausible within that context.
Okay, so the market, according to the source, is betting on the Fed staying put in June. Looking beyond June then, when does the market, based on the views reported in this source article, currently expect the Fed to potentially begin lowering interest rates? Is there a predicted time frame?
Yes, the source provides that longer-term market expectation as well. It states that the prevailing market view is that the Fed will not resume cutting rates until at least September. The phrase used is
At least September. So that positions September as the absolute earliest window the market is currently anticipating for the first rate cut, according to the article's reporting. Not June, not July, maybe not even the meeting in between. September at the earliest.
That's the timing reported in the source based on market views. It implies that market participants believe the Fed will need several more months of incoming data on inflation trends, further labor market developments beyond just this ADP report and the upcoming NFP, and perhaps more clarity on the actual economic impact of those external factors like tariffs before they gain sufficient confidence to finally start easing monetary policy.
So it suggests a longer waiting period is anticipated now, perhaps longer than many might have hoped for earlier in the year before these complexities emerged.
That seemed to be the implication of the at least September expectation cited in the source. The bar for cutting rates is perceived by the market to be quite high right now for the Fed.
And this specific point you mentioned earlier about the potential impact of factors like tariffs maybe having a delayed effect, contributing to the Fed's caution and the market's pushback expectations, that seems to be explicitly supported by another economist cited near the end of the source material.
Yes, the article includes a perspective that speaks directly to this idea of delayed impacts. It cites Moritz Kramer, who is identified as the chief economist at LBBW, a German bank.
And what does Kramer say about the impact of tariffs as reported?
He is quoted or paraphrased as saying that as of now, they haven't seen a clear impact of tariffs on key economic indicators like the labor market or inflation yet. The source uses the phrase, "sukando michingunchingji," haven't seen an obvious shock or impact.
Haven't seen a clear impact yet. That word yet, just like when the Indeed economist used cautious phrasing, seems quite significant here too, doesn't it?
It absolutely is. Because, as reported in the source, Kramer follows up that observation by stating that these impacts may appear with a delay. The phrase used is "yanekustian,"
Kining hui yankichusian.
may appear with a delay. How does that comment, as presented in the source, tie back to the Fed's reported dilemma and the market pushing back rate cut expectations?
It directly supports the idea that the factors contributing to the Fed's difficult position operating under that tariff war shadow might not be fully visible in the economic data right now. The consequences of trade policy changes, tariffs, supply chain shifts, etc., might still be working their way through the complex economic system and could manifest more clearly in the data only later on.
So it adds another layer of uncertainty for the Fed. They might be making policy based on current data, but knowing that delayed effects from things like tariffs could change the picture down the road. Precisely. It suggests that even the current data we've been discussing, the May ADP, the April JOLTS, the upcoming May NFP, might not fully capture the challenges the economy or the Fed could face in the coming months. This potential for delayed impacts adds significant uncertainty to the economic outlook, making policy decisions even more complex, and perhaps justifying both the Fed's reported cautious attitude and the market's expectation, cited by the source, that rate cuts might be pushed out to at least September or even later. It reinforces the idea that the full story isn't known yet.
Wow. So this single ADP report, this one number 37,000, really acted as a focal point, didn't it? As the source details, it immediately brought together all these threads, deep questions about the true health of the labor market, the reliability of market expectations, the intensity of political pressures on the central bank, and the complex web of factors like trade policy that are making the Fed's job so incredibly difficult right now.
It certainly did. It serves as a perfect, concrete illustration of how a single piece of economic data, especially when it delivers a significant surprise like this one did, can instantly connect seemingly disparate threads. It links hiring trends happening on the ground in different sectors to the frantic trading activity on floors in New York and London, to pointed political statements coming out of Washington. It just crystallizes so many of the multiple, often conflicting forces that are currently influencing the economic dialogue and policy debates.
Okay, let's just take a moment to quickly recap the main findings from our deep dive into the source material, just to lock them in. We started with that undeniable surprise, the YP, of the May ADP report, a shockingly low 37,000 jobs added.
Which, as the source detailed, massively missed the 110,000 expectation and represented the weakest private sector hiring number reported by ADP since way back in March 2023, nearly 2 years prior.
We saw how that instantly translated into those textbook market reactions reported directly in the source. The U.S. dollar index falling short-term to 99.019, U.S. 10-year Treasury yields taking a sharp drop, and gold prices getting a pull-up to $369.53, all reflecting rapidly shifted expectations about future growth and, importantly, interest rates.
We then drilled down into those crucial sectoral details provided in the source. We saw a net loss of 2,000 jobs in goods production, driven by reported declines in natural resources mining, -5K, and manufacturing, -3K, despite a continued gain in construction, +6K.
And we saw that complex picture in the services sector, showing some strong signs, with robust gains reported in areas like leisure hospitality, +38K, more than the entire economy's net gain, and financial activities, +20K, but also experiencing significant drag from reported losses in professional business services, -17K, education health, -13K, and trade transport utilities, -4K, really illustrating the unevenness of the reported slowdown.
We examined the wage data reported in the source, noting the interesting tension. Wage growth was characterized as remaining strong and little changed from April, particularly that 7% annual gain for job changers versus 4.5% for job stayers, even as the ADP chief economist, Neil Richardson, was quoted saying that hiring momentum is weakening and the market continues to trend softer.
We then tried to contextualize this ADP report by connecting it to other labor data points mentioned in the source. We explored that apparent contradiction posed by the official April JOLTS report, which showed an unexpected increase in job openings to 7.4 million, beating 7.1 million expectations and hitting a 2-month high, and a job openings to unemployed ratio holding nearly flat at a balanced 1.03.1.
Right. And we also looked ahead, as the source did, to the upcoming official May NFP report, noting the market expectation pre-ADP shock was for 125,000 hires and a 4.2% unemployment rate, but that the source suggested the weak ADP number might cause analysts to think the NFP might slow.
We integrated those expert perspectives cited throughout the source, from ADP's own Richardson confirming weakening momentum, to Indeed's Alison Shrivastava describing the current situation as a painful stalemate driven by limited hiring and low resignation rates, and starkly warning that this period of stable cooling could potentially turn thoroughly cold if things don't improve.
And then, of course, we covered how all of this data and analysis, as reported, immediately triggered that political dimension. We detailed Trump's swift reaction, calling Powell too late, mister, demanding immediate rate cuts, must cut immediately, calling him disappointing, and using that comparison to Europe. Europe has cut rates 9 times.
All set against the backdrop provided by the source of their historically tense relationship, Powell's consistent refusals of past demands, and his reported insistence on policy independence, even during their significant first meeting since 2019, which occurred just last week.
And finally, we tied all of this back to the Federal Reserve's actual stated position, as reported. Maintaining rates unchanged in the 4.25%, 4.50% range since December, and policymakers recently reiterating a cautious attitude. We contrasted this with Wall Street's view, presented in the source, that the Fed is trapped in a dilemma operating under the shadow of a tariff war.
Which, in turn, leads the market, according to the source, to expect no rate cut at the upcoming June meeting and to push back the earliest possibility for easing to at least September, with the added uncertainty, highlighted by the LBBW economist Kramer, that the impact of factors like tariffs might still be delayed, making the Fed's job even harder down the line.
It's quite a tangled web when you lay it all out based on the source.
It really is.
Yeah.
But it makes it abundantly clear that understanding these specific details, these numbers, these quotes, these connections presented right here in the source material is incredibly valuable for you, the listener. It allows you to see the concrete data points and narratives that are actively influencing market behavior, driving political reactions, and shaping the extremely challenging decisions facing policymakers like the Federal Reserve right now. This one ADP report certainly wasn't just some dry statistic. As the source showed, it was a catalyst that exposed many of the complex, conflicting forces at play in the economy today.
It really is a fascinating snapshot, isn't it? A snapshot of that dynamic interplay between hard economic reality, or at least reality as measured by one report, market psychology and expectations, raw political pressure, and the strategic maneuvering of central banks. All highlighted and brought into sharp focus by this single data release, as reported in the source we dissected.
Absolutely. So as we wrap up this deep dive, here's a final thought for you to consider, something to mull over that pulls together the threads and particularly the tensions we've uncovered directly from this source material. Considering that stark contrast the source presented between the surprisingly weak May ADP hiring number signaling a sharp slowdown and the unexpected increase in April job openings from the JOLTS report suggesting resilient demand just a month earlier, and layering on top of that the stated market expectation that the Fed won't cut rates until at least September, despite prominent political figures demanding immediate action. What specific combination of these often conflicting data points, political pressures, and those hard-to-predict external factors, particularly if the potential delayed impact of things like tariffs, as suggested by the economist in the source, starts to actually materialize in the data over the summer, what mix will the Federal Reserve ultimately prioritize when making its crucial decision on if and when to finally adjust interest rates?
That's the multi-trillion-dollar question, isn't it? It really underscores that the path forward for monetary policy, based just on the evidence and tensions presented in this single source, is clearly fraught with uncertainty. Identifying which signals the slowing hiring, the still strong wages, the sticky inflation perhaps, the political noise, the tariff effects the Fed will ultimately deem most important in the coming months, is the key challenge for anyone trying to anticipate their next move, especially when the signals presented, as we saw, appear so contradictory at times.
It certainly is. Something significant to think about as you process all this information we've pulled from the source. By digging into the material like this, piece by piece, you really do get a much clearer, more textured, more nuanced picture of the specific details and the critical tensions that are driving the economic conversation right now.
And that really is the very essence of the deep dive, giving you that detailed perspective.
Couldn't agree more. Thanks for joining us for this deep dive into the latest U.S. employment data reaction. We'll catch you next time.